Why do some people see their wealth grow even when they are not working more hours, while others struggle despite constant effort? The short answer is that capital earns income in multiple ways and compounds over time, while labor income is limited by hours and energy. In this episode, we will examine how interest, rent, dividends, and capital gains turn savings into streams of income, how accounting, law, and markets made those streams reliable, and why small differences in rate, time, and costs lead to large differences in outcomes. We will move from the first recorded debts to modern portfolios and finish with a practical roadmap any viewer can apply. First, we define terms clearly. Money working by itself is a shorthand for returns on capital, interest from lending, coupons from bonds, rent from property, dividends from shares, and appreciation of asset prices. None of these require the owner to exchange new hours for each unit of income. They require initial capital, a contract or ownership claim, and time. When income is reinvested, the base grows and subsequent income is calculated on a larger base. This is compounding. The effect is mechanical and cumulative. Labor income behaves differently. It is paid per hour, per project, or per salary period. It stops when work stops. Skills and careers can raise rates, but there is a ceiling set by time and market demand. Capital does not share that ceiling. One person can own claims on thousands of workers, tenants, borrowers, or customers via markets. This is the core asymmetry we will explore. The story has a long history. Early societies needed credit to smooth harvest risk and trade across time. They used grain or silver as units, recorded obligations, charged premiums for risk and delay, and enforced contracts. Over centuries, religions and states tried to restrain abuse while keeping credit available. Merchants invented workarounds when formal bans appeared. Double-entry bookkeeping improved trust in numbers. Public debt created standardized instruments. Joint stock companies pooled risk and allowed owners to collect dividends without running ships or warehouses. Exchanges published prices and connected buyers and sellers. Each step reduced friction and made returns on capital more predictable. The mathematics behind wealth divergence is simple but unforgiving. A small difference in annual return, sustained over decades, creates a large gap. A 1 percentage point reduction in fees or an earlier start by a few years can outweigh later, larger contributions. Inflation subtracts from nominal returns. Taxes and costs further lower the effective rate. Leverage magnifies both gain and loss. A system that keeps costs low, reinvests consistently, and avoids large losses will usually beat sporadic high returns with high costs and drawdowns. We will quantify these statements with plain arithmetic examples. Institutions and rules matter. Tax codes often treat labor and capital differently. The ability to defer taxes, offset losses, borrow at low rates, and pool assets through funds or corporations changes net outcomes. Access matters as well. Lower borrowing costs, better information, and earlier access to new issues or private deals raise expected returns for those who qualify. Scale lowers unit costs and widens opportunity sets. We will show how these structural advantages accumulate. Behavior matters no less. Many people underperform not because they lack opportunities, but because of timing errors, excessive trading, high fees, poor risk control, or expensive consumer debt. Others follow simple rules, automate contributions, buy broad, low-cost exposure, reinvest income, rebalance on a schedule, keep a reserve, and avoid high-cost debt. Over long horizons, process and discipline often beat superior selection without discipline. We will discuss common errors and the routines that prevent them. Policy and macro conditions influence the distribution of gains. Periods of low interest rates tend to raise asset prices and favor asset owners relative to wage earners. Inflation shifts value between borrowers and lenders. Liquidity programs channel money into particular markets first, benefiting those positioned to receive it. None of this eliminates personal agency, but it explains why wealth concentration can accelerate even when average incomes grow. Crises test every claim. Borrowers with weak cash flow and little equity fail first. Owners with reserves and diversified assets can absorb losses and buy when prices are low. Recovery raises their wealth faster because they control assets that reprice quickly, and they can add exposure when others are forced to sell. We will outline basic risk controls that keep individuals in the game when conditions deteriorate. This episode will proceed in a clear sequence. We will start with the origins of debt and interest, move through medieval restrictions and merchant innovations, then to Renaissance bookkeeping and early banking. We will examine the emergence of public debt and equity markets, the math of compounding, and the main asset classes that pay passive income. We will cover leverage, monetary policy, inflation, taxes and legal structures, scale and network effects, investor behavior, and crisis dynamics. We will finish with a practical checklist: eliminate high-cost debt, build a reserve, automate investments, minimize fees and taxes, choose a simple allocation, reinvest income, rebalance, and maintain discipline across cycles. A few boundaries are important. This is not a promise of quick gains. It is a map of mechanisms that have operated for centuries. Results depend on savings rate, time horizon, costs, and risk management. Small, sustained improvements matter more than occasional big wins. You will see why people with steady processes, access to assets, and time on their side tend to widen the gap over decades. By the end, you will understand how interest and debt evolved into the modern system of returns, why capital income compounds while labor income does not, how institutions, policy, and behavior shape outcomes, and which steps convert these general forces into results for an individual household. The aim is practical clarity: what to do first, what to avoid, and how to keep progress compounding year after year. If you are ready, we will start with the origins of debt and interest and see how early societies priced time, risk, and enforcement, the components that still define every loan and bond today. Credit appears in the historical record as soon as we see organized production, storage, and trade. Early agrarian societies faced the same problem every year. Expenses come before harvest. Seed, tools, labor, and rent must be paid now. Crops and revenue arrive later. That gap created the need for advances and for rules that govern repayment. The result was debt, interest, collateral, and enforcement, centuries before coins and banks. In Mesopotamia, temples and palaces acted as both granaries and administrative centers. They received agricultural surpluses as tax or rent and re-lent grain to farmers as sowing loans. Silver functioned as a unit of account for larger transactions. Tablets record principal, due dates, and premiums. The Code of Hammurabi, circa 1750 BCE, standardized elements of this practice. Obligations were written, collateralized, and enforceable. Maximum rates were specified, commonly cited as about 1/5 per year on silver loans and roughly 1/3 on grain loans. The higher rate on grain reflected storage losses, spoilage, and seasonal risk. Contracts often named guarantors, set penalties for late delivery, and described collateral, including fields or persons. These societies also recognized systemic risk. Droughts, floods, and war could make honest repayment impossible. Rulers occasionally proclaimed amnesties, clean slate edicts that canceled certain debts and freed debt bondsmen. The policy was pragmatic. It restored the tax base and labor supply after shocks. The cycle is clear, even in the earliest records. Credit is necessary for production. Interest compensates time and risk, but unchecked debt can destabilize the entire system. The ancient Near East was not unique. In the Hebrew tradition, sabbatical years and the Jubilee instituted periodic release from debts and return of land. The aim was to limit permanent loss of freedom through debt bondage and to prevent consolidation of land into a few hands. Credit remained essential, but law tried to contain its social side effects. As trade widened in the Mediterranean, credit shifted from the temple storehouse to private hands. Greek city-states saw both the benefits and the dangers of lending. In archaic Athens, debt bondage, citizens pledged as security, became severe enough that Solon's reforms, Seisachtheia, early 6th century BCE, annulled many obligations and banned personal freedom as collateral. After that pivot, lending continued, but with different enforcement: property claims and courts rather than bondage. Greek commerce required credit beyond the farm, maritime loans financed voyages, risk premia were explicit. If the ship returned, the lender received principal plus agreed interest. If the ship was lost, the lender often lost the loan. Effectively a high-risk instrument with terms defined ex ante. This is an early form of limited recourse lending tailored to probabilistic outcomes. Rates varied with season, route, and perceived risk. The same logic underlies modern project finance and trade credit. Rome built a more formal legal infrastructure around similar practices. Contracts like mutuum, a loan of fungible goods, were enforceable in court. Interest, usura, was recognized and periodically regulated. The Republic oscillated between capping or banning interest and tolerating it, depending on social pressure and fiscal needs. Debt bondage, nexum, was abolished, shifting enforcement to property and legal judgment rather than personal servitude. Over time, Roman law refined notions of collateral, priorities, and remedies, concepts that still anchor modern lending. Two common themes appear in these early systems. First, interest is not an arbitrary surcharge. It prices three elements: time preference, resources now versus later, risk of non-repayment, and administrative cost. Second, societies try to balance access to credit with limits on abuse. When credit is scarce or costly, production and trade suffer. When enforcement is harsh or interest unchecked, social instability rises. Law and custom evolve to manage that tension. Religious and philosophical criticism targeted money breeding money, especially where loans financed consumption rather than production. But even in periods of moral restriction, commerce developed instruments that reproduced the economics of interest without naming it directly. In later medieval Europe, direct interest could be condemned, yet merchants used exchange contracts, forward rates, and layered fees to compensate for time and risk within permissible forms. The urge to match cash flows across time, to advance resources against promised returns, did not disappear. It changed shape to comply with norms. Returning to the earliest records, we also see the operational requirements that make credit scale: standardized weights and measures, recognizable units of account, reliable records, and courts that can enforce contracts reduce uncertainty and lower rates. The more predictable the environment, the lower the risk premium, and the more borrowers can afford to invest. Mesopotamian tablets, Greek and Roman law, and later charters are all steps on the same path, turning promises into transferable, enforceable assets. The structure of an ancient loan already contains the elements of modern finance. There is a principal, a schedule, a rate or premium, collateral, and a remedy. There is an intermediating institution, temple, merchant house, or court that records and enforces. There is an information system, scribes, notaries, or ledgers that reduces disputes. The purpose, sowing, trade, bridging a timing gap is clear. These constants explain why the mechanism persisted and expanded. We should separate productive and consumptive credit. Productive loans fund activities that can generate cash flow to repay principal and interest, planting crops, stocking a ship, buying tools. If expected return exceed the cost of funds plus risk, both borrower and lender gain. Consumptive loans fund present spending without creating new output. In poor harvest years, they can prevent starvation, but repeated use without income growth leads to insolvency. Most ancient legal reforms tried to protect citizens from permanent loss of status due to consumptive debt while keeping productive credit available. Even at this stage, redistribution effects are visible. Those with surplus resources, grain, silver, later coin, could earn without additional labor by advancing them to others. Those without surplus paid to bridge time. If the rate was modest and the harvest good, both advanced. If shocks hit, debt could trap borrowers and concentrate assets. The political debate around debt relief and rate caps is as old as lending itself. Finally, note the transition in who lends. At first, central institutions, temples, palaces lent stored surplus. As markets developed, private lenders and merchant networks took the lead, aligning capital supply with opportunity through price, the rate. This decentralization increased access and efficiency but required more robust legal and informational frameworks. The eventual result, public markets and standardized instruments, comes later in our story, but the logic begins here. In summary, the earliest history of debt and interest shows why credit emerges, how interest is justified, and how societies try to control its harms. The mechanism allowed resources to move through time, funding agriculture and trade. It created income for holders of surplus and obligations for borrowers. It required institutions to measure, record, and enforce, and it set the foundation for everything that follows: banking, public debt, equity, and the compounding of returns across generations. In the next part, we will examine how medieval prohibitions against usury collided with economic necessity, and how merchants engineered instruments, bills of exchange, forward rates, and municipal debt that kept capital moving even when explicit interest was frowned upon. In medieval Europe, moral doctrine and economic necessity collided. Canon law condemned usury, taking a payment for the mere passage of time, yet commerce needed credit. The practical question was how to fund trade, urban growth, and public finance without violating religious rules. The answer emerged through contracts that priced risk, labor, and exchange rather than time, and through institutions that provided credit under acceptable forms. The result was a financial system that replicated the economics of interest while observing the letter of the law. Start with the legal baseline. Church councils and scholastic theologians including Thomas Aquinas, argued that money was a sterile medium of exchange, charging for time alone was unjust. Canon law did, however, allow compensation for actual loss, damnum emergens, and permitted recovery of foregone gain in limited cases, lucrum cessans, especially when a lender suffered provable opportunity loss because of a borrower's delay. Penalties for default were distinguishable from interest for the simple passage of time. This distinction became a practical hinge for contract design. Urbanization, trade routes, and fairs created a growing demand for working capital. Merchants needed advances to buy goods, to ship them, and to bridge the time between payment and delivery. The response was a set of instruments that embedded a time premium inside prices or risk-sharing terms. Bills of exchange were the most important of these instruments. A merchant in one city sold domestic currency for a claim payable in another city at a future fair date. The price included both an exchange rate spread and a time component. Because the instrument was framed as foreign exchange rather than a domestic loan, it passed moral scrutiny. Dry exchange, variations arose, where traders cycled funds through different centers to earn the spread repeatedly. Although authorities sometimes condemned abusive forms, the core instrument became the backbone of European long-distance trade finance. Sea loans and bottomry funded voyages. A lender advanced money for a ship or cargo to be repaid with a premium only if the voyage succeeded. If the ship was lost, the lender lost principal. The premium compensated explicit risk, not time per se, and so was considered licit. Rates varied by season, route, and wartime danger. This was an early limited recourse structure that looked like modern project finance. Commenda in Latin regions or kirad in Islamic practice split capital and labor. One party supplied capital, the other supplied effort and skill. Profits were divided by agreement. Losses fell on capital unless negligence was proven. Because the investor's gain was framed as a share of enterprise profits rather than a fixed time fee, the structure satisfied moral rules while supplying risk capital. The logic survives in modern private equity and venture partnerships. Rents and rent charges provided long-duration cash flows. In France and elsewhere, perpetual or life rentees paid a fixed annual sum in exchange for a lump sum price. Courts debated whether these were disguised loans. The defense was that a rent was a sale of an income right attached to land or a communal revenue, not a loan of money. Municipalities financed themselves this way, selling rentes backed by tax streams. In Italy, communal debts formed the monte, pooled obligations with regular payments to subscribers. Venice's prestiti created a liquid market in state debt. Over time, these claims traded at prices reflecting yield and risk, reproducing bond economics inside accepted legal forms. The triple contract, contractum trinius, combined an investment, an insurance, and a sale contract to synthesize a fixed return while distributing risk and ensuring formal compliance. Although controversial and sometimes condemned, it illustrates how jurists and merchants tried to align economic reality with doctrinal requirements. Pawn lending filled household credit needs. Montes Pietatis, charitable pawn banks founded by Franciscans from the 15th century, lent small sums at low cost-covering rates. The charge was presented as a fee to sustain the institution rather than profit on time. These monti competed with private moneylenders, stabilized access to small loans, and reduced predatory terms. Religious minorities and regional specialists had a recognized role. In parts of Christian Europe, Jewish lenders supplied small-scale credit where Christians were restricted from charging interest. They operated under charters that set maximum rates and offered limited protection. Lombard lenders from northern Italy opened pawn shops across Europe. Lombard banking became a generic term for pledge lending. Islamic finance developed in parallel with its own usury prohibition, riba. Instead of simple interest-bearing loans, jurists approved murabaha, cost plus sale with deferred payment, salam, full prepayment for future delivery, useful for farmers needing cash now, istizna, manufacture contracts, mudaraba/musharaka, profit-sharing ventures, and ijara, leasing. Each instrument embedded time value in price or shared profit rather than in an explicit rate, allowing trade and investment to proceed within legal bounds. Cross-cultural trade between Latin and Islamic merchants often used hybrid documentation that each side could reconcile with its own law. Accounting changes made these structures scalable. The spread of double-entry bookkeeping in late medieval and Renaissance Italy improved control over receivables, payables, and inventory. Clear ledgers reduced disputes, supported audits, and allowed firms to separate partners' capital accounts, profit allocations, and credit lines. Information discipline lowered risk premiums and allowed thinner spreads to finance larger volumes. Political entities institutionalized debt. Italian communes and later Northern European cities issued standardized obligations with recorded holders and scheduled payments. Genoa's Casa di San Giorgio managed public revenues and debt servicing, effectively acting like a proto-debt office and bank. Secondary markets developed informally at fairs and in exchanges, where claims changed hands at negotiated prices, allowing investors to exit before maturity and bringing liquidity to what had been illiquid promises. Enforcement evolved away from personal bondage toward property-based remedies. Early medieval Europe sometimes used bodily arrest or servitude for unpaid debts. Over centuries, statutes and practice shifted to attachment of property, sale of collateral, and structured insolvency procedures. Stronger property rights and predictable remedies lowered credit risk and supported lower effective borrowing costs. From a pricing perspective, three components remained central: time, risk, and cost. Canon law removed the right to be paid for time nakedly, but permitted payment for risk actually assumed and for costs actually incurred. Merchants therefore itemized risk and cost and shaped transactions so that the economic surplus corresponded to those headings. A bill of exchange's spread could be defended as compensation for exchange risk and handling. A C loan's premium as compensation for the chance of total loss. A rent's yield as payment for an income right, not time on money. Authorities tried to police the boundary. Councils denounced dry exchange, excessive penalties, and fictitious partnerships with guaranteed returns. City statutes capped spreads and regulated fair dates to limit circular arbitrage. Yet the fundamental demand for capital did not vanish. Each prohibition prompted contract innovation, not the end of credit. The Champagne and later Lyon fairs showed the system at work. Merchants netted mutual claims, settled balances through bills, and extended new credit at agreed terms embedded in exchange rates. By aggregating payments, fairs reduced the need for moving coin, cut theft risk, and created regular calendars for rollover. These mechanisms economized on cash and improved liquidity, preconditions for broader capital markets. Credit also supported state formation and war finance. Monarchs borrowed from merchant houses, pledging tax revenues or monopolies. When defaults occurred, as with English and French crowns in the 14th century, Bankers failed and terms tightened. The lesson for lenders was to diversify exposures and demand better collateral or governance. For states, the lesson was to regularize revenue and build credibility to lower borrowing costs. Those who did, Dutch provinces, and later England, secured durable access to capital and outcompeted rivals. By the end of the medieval period, Europe had a functioning financial architecture, transferable claims, standardized contracts, regular settlement venues, ledger-based control, and courts that enforce property-based remedies. The official stance against usury had not disappeared, but the economy had found ways to fund trade and public needs within accepted legal rationales. The economics of interest, paying for delayed payment, risk, and intermediation re-emerged under different names. Two consequences matter for our larger story about why wealth concentrates. First, those who mastered these instruments earned returns above wages, spreads on exchange, premiums on risk-bearing, and stable payments from public or private rents. Second, scale and information advantages compounded. Merchant houses with correspondent networks, reliable ledgers, and legal expertise could recycle capital continuously, reinvest earnings, and diversify risk. Over time, their capital bases grew faster than labor incomes. This period also showed the persistent redistribution effect of debt, where legal and religious rules sought to protect the vulnerable, charitable institutions and caps offered partial relief. Where enforcement and innovation favored creditors, wealth accumulated in merchant elites and cities with advanced legal systems. The map of European financial centers, Italian city-states, later the Low Countries and England, aligned with places that developed the cleanest instruments within the prevailing moral and legal framework. In summary, medieval prohibitions did not eliminate returns on capital. They redirected them into forms that courts and theologians could accept. Bills of exchange, sea loans, profit-sharing partnerships, rents, municipal debt, and charitable pawn banks supplied credit and created investable income streams. Accounting and law reduced uncertainty. Liquidity and scale followed. The groundwork was set for the Renaissance banking houses and, later, for open capital markets where interest would again be explicit. Next, we will examine how Renaissance bookkeeping, correspondent networks, and early banks, along with public debt and joint stock companies, converted these medieval workarounds into durable systems with clearer prices, better enforcement, and wider participation. The Renaissance transformed finance by standardizing information, separating functions inside firms, and turning scattered merchant practices into reproducible systems. The key change was accounting. Double-entry bookkeeping spread from late medieval Italy and was codified in 1494 by Luca Pacioli's treatise, which described journals, ledgers, debits and credits, and methods to verify balances. With consistent records, merchants could track capital contributed by partners, inventory movements, receivables, payables, and profits by venture. This reduced disputes, supported audits, and allowed investors to judge performance without being physically present at every warehouse or fair. Bookkeeping precision made credit scale. Instead of relying only on personal memory and reputation, firms could present books that reconciled transactions across cities and months. Partners agreed in advance how profits and losses would be split and how much each partner could withdraw. Managers received mandates with limits. Because entries were standardized, an external auditor or a partner in another city could test the arithmetic and detect irregularities early. Clear records lowered the risk premium that lenders demanded and made it possible to operate on thinner spreads. Family banking houses built correspondent networks to move money and information. A house in Florence opened branches in Venice, Lyon, Bruges, and London. Each branch kept nostro and vostro accounts with affiliated houses, recording what it owed to them and what they owed in return. Daily letters described exchange rates, political risks, and the credit standing of counterparties. The network allowed funds to be transferred by book entry rather than by shipping coin. A merchant in Bruges could pay a supplier in Florence by drawing a bill on the network. The two branches cleared the claim internally at agreed rates. This cut transport risk, lowered costs, and accelerated settlement. Bills of exchange matured into transferable credit instruments. A buyer accepted a bill promising to pay at a future date in a stated city. The seller could hold it to maturity or sell it at a discount to a banker who trusted the acceptor. Endorsements created a chain of liable parties, and the reputation of the acceptor and endorsers determined the discount. Because bills tied payment to future fares or settlement dates, they synchronized cash flows across regions. The practice of discounting bills effectively created a secondary market in short-term credit, with prices that reflected both time and credit risk. Letters of credit complemented bills. A banker issued a letter authorizing a correspondent to honor drafts up to a stated amount for a named client. The client could travel and transact without carrying coin, drawing on the letter as needed. The banker charged a fee and relied on the correspondent's reports to reconcile accounts. This instrument linked distant markets and gave mobile merchants predictable access to funds. Partnership forms adapted to the need for scale and control. General partnerships financed trading ventures and workshops. Limited partnerships allowed passive investors to supply capital for a share of profits while capping their liability. Managers received salaries or profit shares but did not always bear full balance sheet risk. These legal forms made it easier to pool capital from multiple households and to separate governance from day-to-day operations. When a venture ended, partners settled according to the books, not by memory or informal claims. Money changing and transfer banking became specialized lines of business. Bankers quoted exchange rates between major cities for delivery on standard usance periods. They arbitraged differences across centers and dates, earning small spreads repeatedly. Because they held many customers' balances, they could offset outgoing and incoming payments, minimizing actual coin movements. The larger the book of customers, the easier it was to net flows and the lower the unit cost for each transfer. Scale produced a cost advantage that attracted still more clients. Risk management improved, but failures were frequent and instructive. Concentrated exposures to sovereign borrowers or to a single commodity trade endangered even the best houses. When a crown defaulted, as happened repeatedly in the late medieval and early Renaissance periods, branch networks collapsed and creditors took losses. The response was diversification of counterparties, shorter maturities, better collateral, and stricter internal limits on lending to rulers. Houses that survived were those that wrote clear mandates, tested counterparties, and required multiple signatures for large credits. Accounting advances changed internal control. Firms closed their books at regular intervals, produced trial balances, and reconciled branch accounts through agreed statements. Inventory was counted and valued. Discrepancies triggered investigation. Voyages and large trades were tracked as separate profit centers, so partners could see which lines earned their keep. Because profits could be measured with more accuracy, investors were willing to fund ventures at lower required returns, knowing they could monitor outcomes and enforce contracts. As printing spread, commercial handbooks standardized contract language, calculation methods for interest embedded in exchange rates, and tables for quick conversion between currencies and measures. Notaries and merchant courts provided forms to validate signatures, authenticate copies of bills, and enforce payment. The predictability of documentation and adjudication reduced friction. Cross-border disputes could be settled using commonly recognized practices rather than local custom alone. Deposit banking emerged alongside merchant finance. Customers placed coin with a banker for safekeeping and received the right to transfer balances by written order. Because many transfers were between clients of the same banker or within a small circle of bankers who cleared with each other, a large fraction of payments occurred through ledger entries. This book money was safer and faster than moving specie through crowded streets or over long roads. The discipline of daily clearing forced bankers to maintain liquidity and to monitor each other's condition. A house that could not meet settlements quickly lost credibility and clients. Legal and municipal innovations reinforced these trends. City governments recognized the public value of reliable payments and sometimes licensed or supervised banks. Statutes clarified the treatment of deposits, pledged collateral, and partner liability on failure. Where courts protected depositors and enforced netting agreements, confidence rose and costs fell. Where law was weak or arbitrary, spreads widened and credit shrank. The boundary between commerce and public finance remained porous. Merchant houses managed tax farms, supplied armies, and advanced funds to rulers against future revenues. Experience taught bankers to demand specific revenue pledges, joint guarantees, or control over collection to protect themselves. Public entities learned that transparent accounts and regular servicing lowered their cost of funds. The bilateral pressure for better records and predictable rule sets advanced both state capacity and private finance. The economics of money working became clearer. With standardized books, a banker could see available capital, current commitments, expected inflows, and credit lines to trusted clients. Idle balances could be deployed into short bills or safe loans. Discounts and fees earned repeatedly accumulated into significant profit over a year. When profits were retained, the capital base rose, and the firm could take on more business at the same risk standards. Compounding moved from a theoretical idea to a routine property of well-run firms. The social distribution of gains reflected access to these tools. Households tied into networks of reliable information and enforcement earned spreads and fees unavailable to casual traders. Apprentices learned methods and rose into partnerships. Cities that offered better courts, notarization, and contract clarity attracted more capital and talent, reinforcing their lead. The financial map of the period. Italian city-states first, then the Low Countries and England tracked where these conditions were strongest. The Renaissance did not eliminate crises or moral debates about finance, but it created an infrastructure in which capital could be pooled, monitored, transferred, and redeployed with lower friction. Double-entry bookkeeping supplied the internal language of control. Correspondent networks and bills supplied the external highways of payment and credit. Legal forms limited liability and defined governance. Together, these elements allowed returns on capital to be earned more steadily and reinvested more reliably than before. This is the context for the next stage, the rise of organized public debt, joint stock companies, and formal exchanges where prices and yields were posted and negotiated in the open. With those institutions, the private techniques of merchant houses became the public architecture of capital markets, and the compounding of income streams widened from elite circles to any investor who could acquire standardized claims. Public finance, colonial trade, and early capital markets turned scattered techniques into a system where capital earned predictable income and could be bought, sold, and scaled. The Dutch Republic led this shift. In 1609, Amsterdam created the exchange bank to settle payments by transfer instead of coin. Bank money was uniform in quality and recorded in ledgers, which reduced fraud and lowered transaction costs. With reliable settlement in place, the Amsterdam Bourse coordinated trade in bills, commodities, and the shares of chartered companies. The Dutch East India Company issued permanent capital in 1602. Its shares paid dividends from Asian trade and could be transferred on the company's books without dissolving the partnership. For the first time, a broad set of investors could own a slice of a large enterprise and exit by selling rather than waiting for liquidation. Secondary trading mattered as much as issuance. When investors could sell claims before maturity, they accepted lower yields and provided more capital upfront. Prices on the bourse reflected expectations about dividends, voyages, and politics. Forward contracts, short sales, and option-like agreements appeared because parties wanted to lock in future prices or hedge cargo risk. Speculation increased volatility at times, but the deeper effect was to make capital mobile. Money moved into the hands of those who could use it and out of positions where investors had better uses for funds. Liquidity turned ownership claims into working instruments. The state adopted similar methods. Dutch provinces and cities sold annuities and life contingent rents to finance war and infrastructure. Regular servicing and transparent accounts reduced default risk. Investors accepted yields below those typical in earlier centuries because enforcement improved and revenues were predictable. A liquid, interest-bearing public debt emerged as a low-risk parking place for surplus funds. That debt became a benchmark for pricing private claims. When a saver could hold a transferable state obligation with scheduled payments, saving itself produced income without management effort. England followed with its own financial revolution. After the late 17th century settlement strengthened Parliament's control over taxation and spending, the Crown could credibly service long-term debt. In 1694, the Bank of England was chartered in exchange for a large loan to the government. The bank organized public subscriptions, made transfers by book entry, and stabilized payments in London. Government debt moved from ad hoc loans to standardized funded securities with regular coupons. Consols later consolidated multiple issues into perpetual annuities that paid steady income and traded at known prices. A rentier could hold these as core assets, reinvest coupons, and compound wealth without running a business. Capital raising for trade and empire used the joint stock form. Chartered companies such as the English East India Company and, later, other monopolies issued shares and paid dividends tied to trade profits. Marine insurance pools at Lloyd's spread voyage risk for a premium, allowing merchants and ship owners to finance larger ventures at lower average cost. Actuarial thinking entered public and private finance. Life annuities, tontines, and insurance contracts priced cash flows using survival probabilities rather than guesswork. With mortality tables and standardized contracts, long-dated promises became calculable and tradable. Coffee houses in London evolved into organized dealing rooms. Brokers matched buyers and sellers of bank stock, government debt, and company shares. Price lists and newspapers reported quotations. The ability to check current prices reduced informational advantage and widened participation. Investors could compare the yield on a government bond with the dividend yield on a company share and allocate accordingly. Present value logic, discounting future coupons and dividends at an appropriate rate, quietly governed decisions. As more participants used the same arithmetic, pricing became more consistent, spreads narrowed, and markets scaled. Colonial trade drove volumes through this system. Spices, sugar, tobacco, and cotton required large upfront investment in ships, inventory, and storage. Credit bridged the time between outfitting and sale. Profits, where they occurred, were reinvested into ships, warehouses, plantations, and financial claims. The Atlantic slave trade, a grave moral crime, generated cash flows that were also channeled through metropolitan markets into debt and equity holdings. The mechanism of accumulation did not judge sources, it recorded and compounded inflows. Capital owners diversified across voyages, commodities, and financial instruments, smoothing results over time. Insurance, both marine and life, completed the architecture. By paying a calculable premium to remove catastrophic loss, merchants and households could take on projects and commitments they would otherwise avoid. This willingness to assume risk at a price supported more lending and more issuance. Insurers invested their reserves in public debt and high-grade loans, earning steady returns between claims. Intermediaries thus sat at the center, taking small fees repeatedly, compounding retained earnings, and growing their balance sheets. The result was a hierarchy of assets with different risk and liquidity. At the base stood funded public debt with regular coupons and an active secondary market. Above it were high-grade bank and insurance shares that earned dividends from fees and spreads. Further up were trading and plantation companies with higher, volatile payouts. Investors matched this latter to their needs. Those with large, patient capital could hold the base and reinvest income. Those seeking higher returns could tilt toward equity and trade finance, accepting drawdowns. In both cases, income streams existed that did not require exchanging new hours for pay. Legal forms reinforced the trend. Transfer registries recorded ownership cleanly. Limited liability evolved, gradually capping investor losses at contributed capital and encouraging broader participation. Bankruptcy procedures prioritized claims and accelerated recovery. Tax collection and customs administration became more systematic, supporting regular debt service. The more predictable the framework, the lower the yield investors demanded, and the larger the pool of investable projects. Costs declined with scale. Large brokers and bankers cleared payments internally, reducing reliance on physical coin. Settlement nets shrank the amount of cash needed to move large values. The difference between gross flows and net settlements represented pure efficiency and translated into higher throughput for the same capital. Institutions with bigger books could quote tighter prices and still earn money, attracting more business and pulling more capital into organized channels. Crises exposed weaknesses but also drove improvements. The South Sea and Mississippi bubbles in 1720 showed how inflated expectations and leverage could push prices far above sustainable values. After losses, governments tightened rules on unchartered companies and disclosure, and investors learned to differentiate between promised schemes and cash-generating enterprises. In the long run, better disclosure and clearer listing standards supported broader, steadier participation. International linkages spread these practices. Dutch funds bought foreign debt. British investors subscribed to canal, railway, and later overseas bonds and shares. Yields adjusted across markets as arbitrage connected them. A saver in one country could finance infrastructure in another through standardized securities. Diversification across regions and sectors became practical for households with sufficient savings, and their income streams became more stable as a result. The mechanisms that explain why wealth concentration accelerates are visible in this period. First, predictable, tradable income assets existed at scale. Households with surplus could buy them, collect coupons and dividends, and reinvest. Second, information and access advantages lowered costs for participants inside the networks. They saw offers sooner, paid lower commissions, and borrowed at lower rates against good collateral. Third, compounding ran continuously because payments were regular and markets remained open most of the time. Missed coupons were rare for top-tier issuers. Reinvestment could be automated by custom or mandate. Public debt played a special role. It provided a near risk-free yield for savers and a funding base for banks and insurers. Because the state taxed widely, its bonds pooled the economy's cash flows and passed part of them to bondholders. That transfer was not hidden. It was the explicit mechanism of funded debt. As the stock of safe assets grew, the group able to live on coupons and dividends broadened. But the relative advantage tilted toward those who could accumulate large positions early and keep them through cycles. All these changes lowered the threshold for capital to work by itself. Investors no longer needed to manage voyages, warehouses, or farms directly. They could hold standardized claims that generated cash and could be sold on short notice. Intermediaries specialized in sourcing, evaluating, and maintaining these claims for a fee that fell with scale. The owners of surplus funds earned market yields with diminishing unit effort, and thereafter cost returns improved as the system matured. By the close of this phase, Europe had the essential components of modern finance: funded public debt with credible servicing, joint stock companies with transferable shares, organized exchanges with published prices, banks that cleared payments by book transfer, and insurers that priced and pooled risk. Each component reinforced the others. Together, they made capital income steadier, more accessible to those with savings, and easier to compound across generations. The next developments would extend these principles: broader shareholder bases, industrial corporations, and legal and tax structures that further standardized returns and strengthened the advantage of those who could save, hold, and reinvest over long horizons. Compounding is the central mechanism behind wealth divergence. Simple interest pays a return only on the original principal. Compound interest pays on principal plus accumulated returns. The difference looks small over a year and decisive over decades. A 1-point change in the effective annual rate or a few years of additional time results in large gaps because each period builds on a larger base. Consider a straightforward comparison with monthly contributions. An investor who puts $300 per month into a broad, low-cost vehicle for 10 years at a 7% annual return, then stops contributing but leaves the money invested for 30 more years, ends around $395,000. Another investor who waits 10 years and then contributes the same $300 per month for 30 years at the same 7% ends around $366,000. The first person contributed a total of $36,000, the second $108,000. Yet the earlier start wins because the longest holding period allows the returns themselves to earn returns. Time dominates contribution size when horizons are long. The rate also dominates, keeping the same 300 per month for 30 years. A 7% return produces about 366,000. At 6%, the result falls to about 301,000, a loss of roughly 64,000 from a 1-point drop. At 5%, the result is about 250,000, more than 100,000 below the 7% path. Fees and taxes that trim 1 or 2 percentage points from the effective rate compound into six-figure differences over a working life. The rule of doubling helps to internalize this. At 7%, wealth doubles roughly every 10 years. At 6%, doubling takes about 12 years. At 3%, it takes about 24 years. When fees, turnover, or taxes push a portfolio from 7 to 5%, the time to double lengthens and the number of doublings available in a career falls. The effect is mechanical. Fewer doublings, smaller ending wealth. Inflation must be accounted for. Nominal returns are what a statement shows. Real returns are what matter for purchasing power. If your portfolio shows 7% nominal for 30 years while inflation averages 3%, the real value of $366,000 in 30 years is about $151,000 in today's money. This is why cash left idle in low-yield accounts loses purchasing power even when the balance does not fall. It is also why tax-efficient compounding at a real positive rate is the core objective, not nominal growth alone. Tax timing changes outcomes. Compare a lump sum of $100,000 compounding for 30 years at 7% with no annual tax versus taxing gains each year at 15%. The first grows to about $761,000 before any terminal tax. The second compounds at an effective after-tax rate near 5.95% and reaches about $566,000. The difference, around $195,000, comes from paying the tax friction every year instead of deferring it. Tax-deferred or tax-exempt accounts exist to reduce this drag. They allow the base to grow unhindered, then take tax later or not at all depending on the jurisdiction and account type. Volatility reduces compounded return even when average annual returns look the same. If an asset drops 50% one year and rises 100% the next, the arithmetic average return is 25%. But the ending value is unchanged. 100 becomes 50, then 100. Compounding works with the geometric mean, not the simple average. High volatility creates volatility drag, lowering the long-run compounded rate. This is one reason diversified portfolios with lower variance can match or beat concentrated portfolios with higher arithmetic averages. The path matters. For savers making ongoing contributions, temporary declines also change share counts. Buying at lower prices can raise long-run wealth if the investor keeps contributing through downturns. Sequence of returns matters most when withdrawing. Two portfolios with the same long-run average can deliver very different outcomes if the bad years happen early during withdrawals. During accumulation, the opposite often holds. Early poor returns paired with steady contributions can increase share accumulation and improve later outcomes. This is a reason to automate contributions and avoid market timing. Process reduces the chance of missing recoveries and avoids concentration of purchases at peaks. Dividends and coupons are a major source of compound growth. Reinvested dividends historically account for a large share of total equity returns. If income is spent instead of reinvested, compounding slows. If income is reinvested automatically and costs are kept low, the base grows each period and future income rises without additional saving. The same logic applies to bond coupons and rental income. Reinvestment policy is a controllable driver of the ending value. Costs compound against you. A fund charging 2% annually when a low-cost alternative charges 0.1 to 0.2% can reduce ending wealth by a third over multi-decade horizons. With the 300 per month example over 30 years at a 7% gross return, paying a 2% annual fee, netting roughly 5%, leads to about $250,000 instead of $366,000. The $116,000 gap is the compounded effect of costs. Trading frequently adds explicit commissions and implicit costs like spreads and taxes. Minimizing all frictions, fees, turnover, idle cash, and leakage raises the effective compounding rate without requiring higher market returns. Debt compounds too, and usually faster. A $5,000 balance at 20% annual interest costs about $1,000 per year just to stand still. Paying $200 per month retires the balance in roughly 33 months with about $1,600 in total interest. Carrying the balance longer transfers more of your future income to the lender's compounding. Paying down high-rate debt is equivalent to earning a risk-free return equal to the interest rate after tax. Eliminating expensive debt is therefore a compounding strategy. It stops negative compounding and frees cash flow for positive compounding. Start time dominates many other choices. Returning to the earlier comparison, the person who saves for 10 years in their 20s and then stops, leaving the account to grow, can end with more than the person who starts 10 years later and contributes 3 times as much. This does not suggest stopping early. It shows the value of early dollars. Each early contribution compounds for more periods. Waiting for the right time often means losing whole compounding periods that cannot be recovered later without much larger contributions. Compounding frequency is a secondary lever. Monthly compounding at a 7% nominal rate yields a slightly higher effective annual rate than annual compounding because returns are credited more often. Over decades, the difference adds up, but it is modest compared to the effect of rate, time, fees, and behavior. It still reinforces the principle that steady, frequent contributions and reinvestments capture more periods and raise the effective outcome. Realistic expectations are necessary. Markets deliver variable returns. No single rate is guaranteed. The task is to build a system that captures the available market return with minimal loss to frictions, survives downturns without forced selling, and repeats the cycle for long enough that the arithmetic has time to work. That system includes a reserve for unexpected expenses, automatic contributions, broad diversification, low fees, disciplined rebalancing, and avoidance of high-cost debt. Each element increases either the effective rate or the number of periods over which compounding can operate. Small improvements compound into material differences, cutting total costs by 1 percentage point, reducing avoidable taxes through appropriate accounts, adding a few years to the horizon by starting earlier, or raising the savings rate by a modest amount, all move the path of wealth meaningfully. These changes are often more powerful than searching for higher risk assets that promise higher headline returns but come with higher volatility, larger drawdowns, or higher fees that negate the advantage. Compounding also explains why wealth concentrates among those with stable access to assets. If income exceeds expenses and a portion is invested regularly at a positive real rate, wealth rises, and the income from that wealth forms a second stream that can itself be reinvested. If expenses exceed income and deficits are financed at high rates, wealth falls and future income is already committed to servicing past consumption. The math is neutral. It favors whichever side the household sits on. Policy, access to low-cost products, and financial literacy determine how many households can move to the positive side. A clear order of operations aligns with compounding. First, eliminate high-rate debt. Second, establish a cash reserve to prevent forced selling during volatility. Third, automate contributions to diversified, low-cost vehicles. Fourth, reinvest income and rebalance on a schedule. Fifth, minimize tax drag with appropriate account types and holding periods. Sixth, avoid interruptions, pauses in saving, panic selling, and long stretches in cash. This sequence raises the effective compounding rate and the number of compounding periods. The core message is practical. Wealth grows when returns are earned on an ever larger base for as many periods as possible with minimal leakage. Time and rate do most of the work. Behavior and cost determine how much of that work accrues to the owner. Those who start earlier, keep costs and taxes low, reinvest, and avoid large losses create conditions where money appears to work by itself. In reality, the work is compounding, operating over long horizons on a base that is protected from avoidable frictions and shocks. Income-producing assets are the practical mechanism by which capital earns without exchanging new hours of labor. Each asset class pays in a different way, carries distinct risks, and behaves differently across inflation and business cycles. Understanding the cash flow mechanics, the main risk drivers, and the practical vehicles for ownership explains how returns are generated and why some combinations compound more reliably than others. Bonds are loans to governments or companies that pay coupons and return principal at maturity. Bond prices move inversely to market yields. The main risks are interest rate risk, measured by duration, credit default risk, and inflation that erodes fixed payments. Longer maturities and lower coupons raise duration, higher coupons shorten it. Investors can hold treasuries, investment grade, or high-yield corporate bonds, and tax-advantaged municipals. Funds and ETFs diversify across many issuers and terms. Laddering individual bonds staggers maturities to reduce reinvestment timing risk. Expected return roughly equals starting yield minus default/fees. Use bonds to dampen volatility and fund known liabilities. Equities are ownership stakes in businesses. Returns come from earnings growth, dividends, and valuation changes, multiples expanding or contracting. Stocks are volatile. Drawdowns are common. But over long horizons, the equity risk premium has rewarded patient investors. Diversify broadly across sectors, geographies, and styles. Low-cost index funds and ETFs make this easy. Total return is driven mostly by fundamentals, durable profit growth, and sensible starting valuations. Buybacks can boost per-share results. Practical habits, rebalancing, dollar cost averaging, and avoiding market timing help capture the asset class's long-term compounding. Real estate generates rent and can appreciate as locations grow scarcer or replacement costs rise. Investors evaluate properties by net operating income, cap rates, and leverage. Income quality depends on tenant credit, lease terms, vacancy, and maintenance. Debt magnifies gains and losses. Higher rates or falling rents can compress values. Real estate can hedge inflation. Rents and replacement costs often rise, but is illiquid and concentrated. REITs offer diversified, tradable exposure with professional management. Core exposures, stabilized residential, logistics, tend to have steadier cash flows than opportunistic projects, development, which carry wider outcome dispersion. Private equity and venture capital invest outside public markets in exchange for a share of ownership and control rights. Returns are realized through operational improvement, multiple expansion, and exits via sale or IPO. Funds typically follow multi-year life cycles. calling capital over time and distributing proceeds later. The J curve describes early negative returns due to fees and investment costs before exits occur. Illiquidity and opacity require a longer horizon and careful manager selection. Fees are higher than in public markets. Headline returns often compress after adjusting for fees, leverage, and selection bias. The potential advantage is access to growth before public listing and the ability to shape operations. The trade-off is capital lockup and higher dispersion between top and median managers. Infrastructure assets, toll roads, utilities, pipelines, renewables produce cash flows under long-term contracts or regulated frameworks. Returns are tied to allowed rates of return, inflation pass-through clauses, and demand stability. These assets can provide income with partial inflation protection, but they carry political and regulatory risk and often use high leverage. Commodities and precious metals differ because they do not produce cash flows. Their expected return depends on price changes, storage, and financing costs. The futures curves carry, and for broad commodity indices, the roll yield from futures. They can provide diversification during inflationary shocks or supply disruptions. Gold is used as a store of value and hedge against currency debasement and tail risk. Its long-term real return comes from price moves rather than income. Because there is no internal compounding from cash distributions, position sizing and the role in the portfolio should be explicit. Hedge, diversification, or speculative exposure. Cash and cash equivalents, treasury bills, money market funds provide liquidity and low volatility with yields that track short-term policy rates. Their real return can be negative during inflationary periods. They are essential for reserves and as dry powder to avoid forced selling, but are not long-term growth engines. Hybrid securities such as preferred shares and convertible bonds sit between debt and equity. Preferreds pay fixed or floating dividends and rank above common equity in the capital structure. Convertibles offer lower coupons with the option to convert to equity, adding equity sensitivity. These instruments can augment income but introduce call features and structural complexity that require attention to terms and issuer credit. Ownership vehicles affect net outcomes. Direct ownership offers control but concentrates risk and requires active management. Pooled vehicles, mutual funds, ETFs, deliver diversification and professional administration at the cost of fees. Index funds minimize selection risk and fees, closely matching asset class returns. Closed-end funds can trade at discounts or premiums to net asset value, introducing an extra layer of market dynamics. Tax-aware vehicles, municipal bond funds in some jurisdictions, tax-advantaged accounts, and REIT structures change after tax income and compounding rates. Selecting low-cost, tax-efficient wrappers increases the effective yield without changing the underlying assets. Risk factors explain a large share of returns across assets. For bonds, term and credit risk are primary. For equities, size, value, profitability, and momentum factors have historically earned premia with variability over time. For real estate, cap rate shifts and rental growth drive returns. Correlations between assets change across regimes. Diversification reduces portfolio variance when correlations are low, but stress periods can push correlations higher. The practical response is broad diversification across independent cash flow sources and risk factors, not reliance on a single driver. Inflation and interest rate regimes influence relative performance. Fixed coupon bonds suffer when inflation and rates rise. Inflation-linked bonds and short duration fare better. Real assets with pricing power. Certain equities, real estate with index-linked leases, infrastructure with pass-through terms, tend to preserve real income. In disinflationary periods with falling rates, long-duration bonds and high-growth equities benefit as discount rates decline. A balanced allocation aims to earn across multiple regimes rather than optimizing for one. Leverage is a choice that changes the distribution of outcomes. Using debt to enhance returns can be appropriate when cash flows are stable and coverage is ample. It is destructive when cash flows are cyclical or volatile. For households, paying down high-rate consumer debt is often the highest guaranteed return. For real estate or businesses with durable cash flows, moderate, well-structured leverage can raise equity returns, provided covenants, amortization schedules, and refinancing risks are conservative. Costs and taxes are controllable, expense ratios, trading costs, and advisory fees reduce gross yield and compound against the investor. Tax drag from frequent turnover or realizing short-term gains lowers the effective after-tax rate. Long holding periods, low turnover funds, and use of tax-advantaged accounts improve net compounding. Dividend policies matter for taxes. In some systems, qualified dividends and long-term gains are taxed at lower rates than ordinary income, while in others, dividend taxation is heavier. Structuring around prevailing rules increases retainable income. Reinvestment policy determines whether cash flows translate into growth. Coupons, dividends, and rents that are consumed do not compound. Systematic reinvestment, automatically adding income to the chosen allocation, raises the base on which future income is calculated. In retirement or distribution phases, a spending rule aligned with expected portfolio yield and volatility reduces the risk of depleting principal during adverse sequences. Risk control preserves the compounding engine. Concentration in a single issuer, sector, or strategy raises the chance of permanent impairment. Diversification across issuers and geographies, limits on position size, and avoidance of opaque leverage reduce tail risk. Liquidity buffers prevent forced sales at depressed prices. Matching asset liquidity to liability timing avoids selling long-term assets to meet short-term needs. Across all these assets, the common pattern is straightforward. There is a source of cash flow: interest, coupon, rent, dividend, regulated tariff, or realized gain. There is a risk set that must be priced and managed: default, rate changes, vacancies, earnings variability, regulation, or commodity price swings. There is a vehicle to hold the claim at some level of cost and transparency. Net returns equal cash received plus or minus price changes, less expenses and taxes. When cash flows are reinvested and drawdowns are survived without forced selling, the base grows and subsequent income increases without new labor input. Asset selection should start with the role each plays. Bonds stabilize income and offset equity drawdowns but carry inflation and duration risk. Equities drive long-term growth and inflation participation but add volatility. Real estate provides income tied to local economies with moderate correlation to equities and sensitivity to rates. Alternatives can diversify or hedge specific risks but require discipline on size and fees. Cash ensures optionality and resilience. Aligning these roles with horizon, liquidity needs, and risk tolerance creates a portfolio that can earn, reinvest, and continue compounding through varied conditions. This is how capital becomes a second income stream. The owner decides the allocation, minimizes avoidable frictions, and lets time do the work. The underlying mechanics are not hidden. They are the coupons paid, the rents collected, the dividends declared, and the cash flows priced into regulated assets. With consistent reinvestment and risk control, these flows accumulate into larger claims on future cash flows, and wealth rises without adding hours of labor. Leverage is the use of borrowed funds to increase the scale of an investment. It changes both expected return and the distribution of outcomes. If the asset return exceeds the financing cost after expenses and taxes, leverage raises the equity return. If the asset return falls short or arrives late while obligations remain due, leverage accelerates losses and can force sales. Understanding cash flow mechanics, covenants, refinancing risk, and how small shocks propagate through a levered position is essential before using debt. Start from first principles. Suppose an asset yields 8% before financing and costs 1% per year to operate. Unlevered return is 7%. If 50% of the purchase is financed at 5% interest, interest expense is 2.5% of asset value. The equity investor now earns 7 minus 2.5 equals 4.5% on the full asset, but on only half the capital contributed. Return on equity is 4.5 divided by 0.5 equals 9, higher than the unlevered 7%. If financing costs rise to 7% or the asset yield falls to 6%, equity return compresses or turns negative. The arithmetic is straightforward and continuous. The institutional constraints around it are not. Financing terms define the path. Fixed rate, fully amortizing loans have predictable cash outflows and gradually reduce leverage as principal is repaid. Interest-only loans keep leverage constant until a balloon payment at maturity, creating refinancing risk. Floating rate debt transfers interest rate risk to the borrower. When policy rates rise, interest expense rises immediately. Covenants add triggers: a minimum interest coverage ratio, ICR, a debt service coverage ratio, DSCR, or a maximum loan to value, LTV. Breaching a covenant can force a capital injection or asset sale even if the project is solvent in the long run. Refinancing risk is often underestimated. A project that works at 5% funding cost may fail at 8% if cash flows are flat. A borrower who relied on rolling short-term funding faces maturity walls when markets tighten. The solution is structural. Ladder maturities, match debt tenor to asset life, avoid concentrations of maturities, and maintain committed backup lines. Stress testing should assume rate shocks, revenue drops, and wider credit spreads occurring together. Margin leverage in securities markets is more fragile. A broker loans part of the purchase price of a portfolio and sets initial and maintenance margin requirements. If portfolio value falls so that equity falls below maintenance margin, the broker demands cash or sells positions to restore ratios. This margin call enforces deleveraging at the worst time. Example: an investor buys 100 of stock with 50 of equity and 50 of margin debt. A 20% price drop reduces asset value to 80. Equity is now 30. If maintenance margin is 30%, any further loss triggers liquidation unless the investor posts cash. Forced selling realizes losses and removes the chance to participate in recovery. Lower leverage or more cash buffer reduces this risk. Real estate illustrates both benefits and hazards. Consider a property with net operating income, NOI, of 6% of value. With a 60% LTV, 30-year fixed mortgage at 5%, and adequate reserves, DSCR can be well above 1.25 and equity cash yield can exceed NOI due to leverage. If market rents decline 10% and expenses rise 5% while refinancing rates jump 300 basis points at loan maturity, DSCR can fall below covenant LTV can rise as appraisals move lower and refinancing can require a paydown. Properties financed with floating rate debt experience immediate cash flow squeeze when rates rise. Interest caps limit the damage but cost money upfront. Sensitivity tables that vary rents, vacancies, cap rates, and interest rates show how quickly coverage can erode. Corporate leverage interacts with operating leverage. A business with high fixed costs has earnings that move more than proportionally with revenue. Adding financial leverage amplifies this further. Rating agencies track interest coverage, leverage ratios, debt to EBITDA, free cash flow, and liquidity sources. Deterioration raises borrowing costs and can close access to markets. Firms mitigate this with staggered maturities, revolvers, covenant headroom, and cash buffers. The optimal capital structure trades the tax shield of debt against the expected cost of distress. The optimum shifts with business risk and market conditions. There is no static answer. Banks are specialized leverage machines. They fund long-dated, risk-weighted assets with a mix of deposits and wholesale funding, maintaining thin equity layers relative to assets. Regulatory capital ratios, liquidity coverage LCR, and net stable funding NSFR aim to prevent runs and maturity mismatches from becoming systemic failures. Repo markets, collateral haircuts, and securities lending define how quickly banks and dealers can turn assets into funding. When haircuts rise in stress, balance sheets shrink unless offset by central bank liquidity. This procyclical tightening forces asset sales, lowers prices, and further raises haircuts. Leverage adds non-linearity to drawdowns. A 10% asset loss with 50% leverage halves equity. With 80% leverage, it wipes out equity. The probability of ruin rises with leverage and volatility. Position sizing methods, such as Kelly-type fractions, derive sustainable leverage from expected excess return and variance, but estimates are noisy and change in stress. Using conservative fractions and imposing hard caps on leverage provide a margin for error. Stop-loss orders do not eliminate gap risk. Only lower exposure and higher liquidity buffers do. Tax rules influence leverage decisions. Interest is often deductible for businesses, reducing after-tax cost of debt and making leverage appear cheaper than equity. Limits on deductibility, thin capitalization rules, and jurisdictional differences affect the net benefit. For households, mortgage interest deductibility varies. After-tax comparisons should be used when evaluating funding choices. A 6% pre-tax rate may be 4.5% after tax for a firm, but the same loan may be a full 6% cost for a household. Not all leverage is recourse. Project finance typically uses special purpose vehicles where lenders have claims on project cash flows and collateral, but not on the sponsor's other assets. This ring fencing isolates failures and lowers sponsor risk, but lenders demand higher spreads and stricter covenants. Non-recourse structures can be appropriate where cash flows are contracted or regulated and construction risk is contained. Full recourse should be reserved for situations where the borrower controls multiple levers to stabilize cash flows. Short selling is leverage in reverse. Borrowed securities are sold for cash with the obligation to repurchase later. Losses are theoretically unbounded if the price rises. Borrow costs and recall risk add to the burden. Position limits, hedges, and strict risk governance are mandatory for short exposure. For most long-term investors, explicit shorting is not necessary to achieve diversification or risk control. Household debt requires a separate lens. High-rate consumer credit compounds against the borrower and transfers future income to lenders. Paying down credit cards or payday loans is equivalent to earning a high, risk-free after-tax return. Auto loans and buy now pay later products increase fixed expenses and reduce flexibility. Mortgages can be productive if they finance a stable residence within conservative debt-to-income DTI limits and fixed rates. Adjustable rate mortgages expose households to policy cycles. A 300 basis point reset can add hundreds per month to payments. Emergency funds and insurance prevent a temporary income shock from turning into a forced sale. Risk management for leverage is concrete. Set maximum LTV or portfolio leverage ratios well below lender limits. Target DSCR and ICR with buffers that hold under adverse but plausible scenarios. Use fixed rate or hedged funding for long duration assets to reduce interest rate mismatch. Ladder debt maturities to avoid single large bullets. Maintain unencumbered assets that can be pledged for liquidity. Avoid cross defaults and cross collateralization that contaminate otherwise healthy assets. Prefer non-recourse where cash flows are ring-fenceable. Document escalation paths for covenant breaches before they occur. Liquidity is a separate constraint from solvency. A levered position can be solvent at fundamental value but fail if it cannot meet near-term cash calls. Holding cash, committed credit lines, and readily saleable securities prevents forced liquidation. Avoid using short-term funding for long-term or illiquid assets. Roll risk is real even in normal times. Monitor counterparties and rehypothecation terms. In stress, collateral chains matter. Leverage interacts with valuation. Paying high prices for cash flows while also borrowing increases fragility. A modest change in cap rates or earnings multiples can erase equity. Buying with a margin of safety reduces the chance that ordinary valuation swings trigger covenant breaches. Conservative underwriting assumes lower exit multiples, higher required yields, and longer payback periods. Size leverage to the reliability of the cash flows. Regulated utilities with tariff pass-throughs can support higher debt than cyclical commodity producers. Stabilized multifamily real estate with diversified tenants can support more than a speculative development with lease-up risk. Broad equity index exposure on margin is more brittle than unlevered exposure because market volatility is high and margin terms change in stress. The discipline is to align leverage with the stability of cash flows and with the speed at which conditions can change. Quantify downside first. Model a 25 to 30% equity market drop, a 150 to 300 basis point rate rise, or a 10 to 20% rent decline, and test whether the position survives without breaching covenants or exhausting liquidity. If survival depends on perfect refinancing conditions or uninterrupted growth, leverage is too high. Can I hold through a full cycle is a better question than how much can I borrow today? Leverage can be beneficial when it lowers weighted average cost of capital and funds projects whose unlevered return exceeds the after-tax cost of debt with a margin for error. It is harmful when used to reach for return on assets that do not generate stable cash flows or when it funds consumption. The difference between productive and unproductive leverage is whether the financed asset generates enough cash to service the debt across a range of conditions. For individual investors, a practical approach is simple. Do not carry high-rate consumer debt. Use fixed-rate mortgages sized to conservative DTI ratios. Avoid margin leverage on volatile portfolios unless you can meet calls from external cash without selling. If using leverage in real estate, keep LTV below levels that would breach DSCR under a stress case and maintain cash reserves for repairs, vacancies, and rate shocks. In all cases, treat the ability to hold through drawdowns as the priority. Compounding stops if you are forced to sell. Leverage is not required to build wealth. Unlevered, diversified portfolios, steady contributions, and time produce substantial outcomes. If leverage is used, it should be a measured tool, sized to cash flows, and governed by explicit limits and contingency plans. Done this way, it can raise return without raising the probability of ruin. Done carelessly, it converts ordinary volatility into permanent loss. Monetary policy sets the price of time for the economy and transmits through credit markets to asset prices, wages, and distribution of income. Central banks target short-term interest rates and, when needed, alter their balance sheets by buying securities. Commercial banks create most money by extending credit, constrained by capital, liquidity, and borrower demand. Fiscal policy interacts by changing deficits, public debt supply, and transfers. The combined effect determines inflation trends, real interest rates, and the relative fortunes of savers, borrowers, wage earners, and asset owners. Inflation changes real purchasing power. When prices rise faster than nominal returns on cash and fixed coupons, holders of money and fixed-rate claims lose real wealth. Borrowers with fixed nominal debt gain because they repay in discounted currency. Lenders lose unless rates and terms adjust. If inflation is anticipated, contracts embed higher rates and indexation. If it is unanticipated, it redistributes wealth abruptly. Index-linked securities and cost of living adjustment shifts some risk back to issuers and employers, but indexation is partial and uneven across sectors. Low policy rates and stable inflation tend to raise the prices of long-duration assets. When discount rates fall, the present value of distant cash flows rises. This boosts valuations of equities with long growth runways and the prices of long-dated bonds and real estate with stable rents. Lower funding costs also support higher leverage for companies and households, increasing demand for assets and reinforcing the price effect. The distributional impact is clear. Households that already own financial assets and property see balance sheets rise. Those concentrated in cash or labor income see smaller direct gains. The gap is wider when asset ownership is concentrated. Large-scale asset purchases by central banks work through several channels. Buying government and agency bonds removes duration from private portfolios and compresses term premia. Investors rebalance into riskier assets, pushing up their prices and lowering yields. Banks receive reserves in exchange for sold securities. Reserves themselves do not cause lending without credit-worthy demand, but lower yields and higher collateral values ease financing conditions. The first-round recipients of purchases are institutions that already hold securities. The wealth effect travels through asset prices into broader spending slowly and unevenly. This sequencing creates visible dispersion. Asset owners benefit earlier and more strongly than wage earners. Yield curve shape matters for intermediaries and credit supply. A steep curve with long rates well above short rates improves bank net interest margins and encourages maturity transformation. A flat or inverted curve compresses margins and can slow credit creation even if policy rates are low. When central banks anchor short rates near zero and buy long bonds, the curve can flatten, supporting valuations but reducing carry for lenders. The consequences show up in who earns spreads and how much credit flows to the real economy. Inflation regimes change winners and losers. In high and rising inflation, fixed coupon bonds lose in real terms. Short duration and inflation-linked bonds perform better, and borrowers with fixed-rate debt gain. Companies with pricing power, low input intensity, and low fixed rate debt can defend margins. Others see earnings compressed. Real estate with index-linked leases or frequent repricing preserves income. Regulated assets with inflation pass-through clauses maintain real cash flows. Commodities and producers of scarce inputs can benefit when supply constraints dominate. In disinflationary periods with falling rates, long-duration bonds rally and growth equities gain as discount rates decline. Companies that can refinance at lower rates see earnings rise. Financial repression is a policy configuration in which nominal interest rates are kept below inflation for extended periods, reducing the real burden of public and private debts. Governments can achieve this through caps, regulations that steer savings into government bonds, and central bank purchases. The effect is to transfer resources from savers in fixed income instruments to borrowers, notably the sovereign. After major wars, several countries used this approach to reduce debt to GDP ratios. The cost falls on depositors and conservative savers who earn negative real returns unless they shift into risk assets. Exchange rates and external balances add another layer. Currency depreciation raises import prices and domestic inflation but can improve the competitiveness of exporters and increase local currency revenues for commodity producers. Holders of foreign currency debt suffer when the local currency weakens. Hedging changes the impact. Global investors compare real yields adjusted for currency risk across markets. Capital flows toward higher real yields until risk adjustments offset the advantage. Emerging economies face larger pass-through from exchange rates to inflation and often must set higher policy rates to anchor expectations, which can slow growth and depress asset valuations. Unexpected inflation produces the sharpest redistribution. Fixed income retirees and wage earners on delayed contracts lose purchasing power. Leveraged property owners and firms with fixed rate debt gain in real terms if rents and prices reset while debt service is fixed. Tax systems that tax nominal gains amplify distortions. Assets that merely keep up with inflation can generate taxable gains on the inflation component, reducing real after-tax return. Indexation of tax brackets and capital gains rules mitigates but rarely eliminates this effect. Low-rate regimes with central bank balance sheet expansion increase the market value of existing assets and lower the hurdle rate for new projects. Corporate managements respond by refinancing, buying back shares, and raising leverage for acquisitions. The immediate beneficiaries are shareholders. Wage gains tend to follow with a lag and depend on labor market tightness. If productivity growth is weak, profits can rise as a share of income while real wages stagnate, raising measured inequality even as overall employment improves. When rates rise later, valuations compress, financing costs increase, and the tailwind reverses, firms with stronger balance sheets and flexible cost structures adapt more easily. Debt structure determines household outcomes across regimes. Fixed-rate mortgages protect borrowers from rate hikes and allow them to benefit from wage and price inflation. Adjustable rate mortgages transmit policy increases directly into monthly payments. High-rate consumer debt compounds rapidly in any regime. Inflation helps only if nominal incomes rise and rates do not reset, which is rare for revolving credit. Maintaining conservative debt-to-income ratios and favoring fixed-rate terms where available reduces exposure to policy cycles. Duration is the key metric for interest rate sensitivity across assets. Long-duration bonds fall most when yields rise. Equity sectors with cash flows far in the future, like early-stage growth, also have high effective duration. Value and dividend pairs with near-term cash flows have lower duration. Real estate duration depends on lease terms and cap rate sensitivity. Portfolio construction that mixes different duration profiles reduces sensitivity to any single rate path. Policy credibility and expectation management influence outcomes as much as current settings. If a central bank is perceived as unwilling or unable to control inflation, risk premia rise across assets and long rates move independently of short rate guidance. Conversely, credible commitments to maintain low inflation anchor term premia and allow lower long rates for the same short rate. Communication shapes expectations for growth and inflation and thus valuations. The history of disinflation in the 1980s shows how credible tightening raised real rates, depressed bond prices initially, and set the stage for multi-decade gains once inflation expectations fell. Distributional effects arise from ownership and access. The top deciles typically own a larger share of equities, real estate, and private businesses. When policy elevates asset prices or lowers funding costs, these households see larger balance sheet gains. Households without assets or with only deposits see little benefit and may face higher living costs. Expanding access to low-cost investment vehicles, tax-advantage savings plans, and default enrollment in retirement systems reduces this gap over time. Financial literacy and stable savings channels help more households capture positive real returns despite policy cycles. Practical positioning depends on regime assessment and humility about forecasts. A resilient allocation includes short-duration bonds and cash for liquidity, inflation-linked bonds for unexpected inflation, broad equities for growth and earnings participation, real estate and infrastructure with pricing power for partial inflation hedging, and a measured allocation to commodities or commodity producers for supply shocks. Within equities, favor balance sheet strength, free cash flow, and pricing power when inflation is elevated. Favor duration and reinvestment when disinflation prevails. Keep costs and taxes low and avoid leverage that would force sales if rates jump. For individuals and institutions, the priority is to maintain a compounding engine across regimes. That means matching asset liquidity to liabilities, avoiding concentration in single risk factors like long duration without hedges, and using account types that minimize tax drag on real returns. It also means recognizing that policy can change quickly. Buffers and diversification are more reliable than point predictions. Monetary policy and inflation do not create wealth by themselves, but they shift relative prices, discount rates, and financing conditions. Those who own assets with positive exposure to falling rates and rising liquidity benefit quickly in low-rate expansions. Those who own assets with inflation pass-through and fixed-rate liabilities benefit during inflationary periods. Households and firms without assets or with mismatched liabilities absorb the costs. Over decades, these regime effects compound with differences in savings rates and access, explaining a significant share of why wealth grows faster for those who already hold scalable claims on cash flows. Tax rules, legal structures, and institutional advantages change net returns in ways that compound over time. Two people with the same gross market return can end with very different wealth because one pays lower taxes and fees, defers more, accesses cheaper funding, and faces fewer frictions. Understanding these mechanics explains part of why capital held by the already wealthy grows faster. Most systems tax labor and capital differently. Wages are taxed as ordinary income when earned and often face payroll levies. Capital gains are typically taxed on realization, not accrual, which creates deferral. Untaxed growth compounds until an asset is sold. In many jurisdictions, long-term gains and qualified dividends are taxed at lower rates than wages. This spread, plus deferral, raises the effective after-tax return on capital relative to labor. Where tax is due annually on interest or short-term gains, the effective compounding rate falls, sometimes by 1 to 2 percentage points. Over decades, a 1-point difference in after-tax return produces a large gap in ending wealth. Deferral accounts amplify this effect. Tax-deferred retirement plans, pensions, and certain savings schemes allow contributions to grow without current tax and either tax withdrawals later or exempt them entirely depending on the design. The arithmetic is direct. Compounding a given gross return without annual tax friction produces a higher terminal value. The later and lower the tax, the larger the net. Auto-enrollment and employer matches further accelerate accumulation by adding external contributions and reducing behavioral slippage. Households without access to these vehicles or who do not use them lose years of untaxed growth. Entity choice matters. Corporations, partnerships, and pass-through entities allocate income and tax in different ways. Limited liability isolates business risk from personal assets, which allows owners to take on projects without endangering outside wealth. Pass-through structures can avoid a layer of corporate tax by taxing owners directly. Corporate forms can retain earnings and time distributions. Some jurisdictions offer imputation credits to avoid double taxation of dividends. Others do not, creating incentives to favor buybacks or retained earnings. Selecting the right wrapper for a given activity changes net yield after tax and fees. Depreciation and amortization are non-cash deductions that shelter income from tax. Real estate allows cost recovery over statutory schedules and, in some systems, accelerated depreciation or cost segregation that front-loads deductions. The result is higher after-tax cash yield for a time, even if economic depreciation is slower. When combined with conservative leverage and stable rents, the tax shield can materially raise equity returns. In other industries, amortization of intangibles and accelerated capital allowances play similar roles. These are lawful timing differences that shift tax later and let more capital compound now. Loss rules and harvesting affect outcomes. Capital losses can offset gains in many systems and, if unused, carry forward to future years. Systematic tax loss harvesting in diversified portfolios realizes losses to offset gains while maintaining market exposure within rule boundaries. This raises after-tax return without changing gross market exposure. Wash sale and anti-avoidance rules limit abuse. Within those limits, disciplined harvesting produces persistent tax alpha. Realizing gains unnecessarily, frequent turnover, and short-term trading usually increase tax drag. Cross-border investors face withholding taxes on dividends and interest. Double tax treaties reduce these rates when the investment is held through a treaty-eligible domicile. Institutional investors often use fund structures domiciled in jurisdictions that minimize withholding and reclaimable taxes at the fund level. For individuals, using collective vehicles that already optimize treaty benefits can raise net yield versus holding the same securities directly from a less favorable jurisdiction. The difference is structural, not skill-based. Estate and gift rules determine how wealth moves across generations. Some systems levy estate or inheritance taxes above thresholds. Others tax at the recipient level or not at all. Step up in cost basis at death. Where it exists, eliminate unrealized gains for heirs and reset the tax clock, making deferral across generations extremely powerful. Trust, foundations, and family holding companies can centralize control, separate management from ownership, and implement long-term distribution policies. Life insurance wrappers and charitable vehicles provide additional deferral or exemption in some frameworks. Families who plan within the rules retain more capital across transitions and preserve compounding. Those who treat each generation's wealth as fully taxable at transfer lose a large share. Interest deductibility creates asymmetry between borrowers. Businesses often deduct interest expenses, lowering the after-tax cost of debt and making leverage appear cheaper than equity. Households usually cannot deduct interest on consumer debt and sometimes not even on mortgages. Depending on jurisdiction, companies with stable cash flows and tax capacity benefit more from debt shields. Households with high-rate consumer credit suffer from non-deductible compounding. Thin capitalization limits and interest caps constrain corporate shields, but the net effect still favors entities with earnings to shelter. Institutional investors compound faster because they buy at lower cost and with better terms. Large funds negotiate management fees down, trade through low-cost venues, cross orders internally to avoid spreads, and borrow at lower rates against high-quality collateral. Securities lending generates incremental income by lending portfolio holdings for a fee, reducing net expense ratios. Prime brokerage relationships provide balance sheet, term financing, and access to bespoke hedging. Legal and compliance teams structure holdings to minimize withholding taxes and optimize treaty claims. The sum of these small advantages is a persistent improvement in after-fee, after-tax returns. Access widens gaps. Primary allocations in new issues, private placements, and co-investments come first to investors with scale and established relationships. Private equity, venture capital, and private credit funds often limit entry to qualified investors due to regulation and capacity. These vehicles can add return drivers not available in public markets, but even when returns are similar to public proxies, fees and carried interest channel a share of the gross return to managers. Institutions with bargaining power reduce that drag. Smaller investors pay full price or are excluded entirely. Operational discipline converts structural advantages into results. Endowments, family offices, and pension funds run documented investment policies, rebalance on schedule, and maintain liquidity buffers. They do not stop contributions in drawdowns and rarely sell at lows to meet spending because liabilities are matched and credit lines are in place. This prevents the most expensive mistakes, forced sales, and missed recoveries. The same policy logic is available to households through automated contributions, tiered liquidity, and written rules, but many do not implement it. Regulation shapes incentives. Disclosure standards and listing rules reduce information asymmetry and protect minority shareholders, which lowers the return premium investors demand. Tax-advantaged retirement systems push households into regular saving by default. Consumer credit rules cap abusive rates and fees, while bankruptcy law defines how failed borrowers exit. Where rules are clear and enforcement is credible, borrowing costs fall and investable projects increase. Where rules are opaque or arbitrary, spreads widen and only insiders profit. There are limits. Anti-avoidance doctrines collapse artificial schemes lacking substance. Controlled foreign company rules, transfer pricing, and reporting regimes constrain aggressive tax planning. Interest deductibility is limited by earnings tests, and hybrid mismatches are targeted. These measures do not remove lawful deferral or the structural benefits of low-cost, diversified investing. They reduce the gains from complexity without substance. Simple, compliant optimization is accessible. Use tax-advantaged accounts where available. Prefer low turnover, low fee funds to minimize realized gains and expenses. Harvest losses within the rules. Hold higher yielding, tax inefficient assets in tax deferred accounts and tax efficient equity index funds in taxable accounts, subject to personal circumstances. Choose entity forms that match activity and risk. Avoid high rate consumer debt. Keep good records for basis and holding periods. These steps lift after-tax return without forecasting markets. Scale enhances every improvement. A 1 percentage point reduction in combined fees and tax drag applied to a small base is modest. Applied to a large base for decades is decisive. Families and institutions that sustain low friction, consistent reinvestment, and disciplined risk control see their advantage widen over time. They also benefit from cheaper credit, better liquidity during stress, and earlier access to opportunities. The compounding is not only financial, process knowledge, governance, and professional networks accumulate and further reduce frictions. Distributional outcomes follow ownership and rules. Households with assets in tax-advantaged vehicles, access to low fees, and stable policies keep more of gross returns. Households concentrated in wages and deposits pay full tax immediately and earn low real returns. Bridging this gap requires broad access to saving vehicles, default enrollment, transparent low-cost products, and financial education focused on taxes, fees, and behavior. For individuals, moving from ad hoc saving in taxable accounts to a structured, tax-aware plan is a practical way to shift from the disadvantage to the advantage trajectory. Wealth grows where the net compounding rate is highest and the number of compounding periods is longest. Tax design, entity choice, access, and operational discipline all raise that net rate. None of these factors guarantee higher gross market returns. They determine how much of those returns the owner keeps. Over long horizons, retention is as important as selection. This is a central reason why capital held by those with the right structures, accounts, and policies tends to grow faster than capital without them. Scale and networks change how returns are generated and who captures them. When fixed costs are high and marginal costs are low, each additional unit of output lowers average cost. If price does not fall as quickly as cost, margins expand with volume. Firms that reach scale earlier can reinvest higher margins into product, distribution, and acquisition, raising barriers for smaller rivals. This is not limited to manufacturing. Software, platforms, and financial intermediation all exhibit high fixed costs and near zero marginal costs, which makes scale a central driver of profitability and market power. Network effects add a separate mechanism. In a two-sided platform, more users on one side attract more participants on the other, increasing value for both. Payment networks, marketplaces, social platforms, and operating systems are examples. Once a network reaches critical mass, new entrants face a coordination problem. They must persuade users to join a smaller network with less liquidity, inventory, or audience. Incumbents can maintain leadership with compatibility tools, APIs, and incentive schemes that keep participants engaged while they collect fees on every transaction. Returns to the platform owner rise with volume even if fee rates fall modestly, because fee revenue equals price times quantity, and quantity grows quickly in successful networks. Data and learning effects reinforce this dynamic. Larger user bases generate more data, which improves matching, fraud detection, risk scoring, and recommendations. Better models increase user satisfaction and conversion, which attracts more users. This feedback loop reduces customer acquisition cost per unit of revenue and allows incumbents to outbid rivals for traffic without eroding unit economics. In finance, larger lenders build better credit models, lowering default rates and funding costs, which permits lower prices for good borrowers and higher margins on riskier segments. In trading, larger market makers see more order flow, refine pricing models, and earn tighter spreads across more instruments. Scale reduces cost of capital. Large, profitable firms borrow at lower spreads and for longer maturities. They issue equity and debt at lower fees per dollar. They can securitize cash flows, spin out assets into specialized vehicles, and arbitrage tax and regulatory differences through internal structures. A lower discount rate raises the present value of future cash flows and supports higher valuations that can be used as acquisition currency. Smaller firms pay more for the same capital and face more restrictive covenants, which limits their ability to compete through investment in product and distribution. Distribution advantages compound. Big platforms and retailers negotiate better terms with suppliers, capture co-op marketing budgets, and use their channels to launch adjacent products at lower incremental cost. In asset management, large funds cross orders internally, reduce market impact, and negotiate sub-basis point trading costs. They lend their securities for additional income and borrow against portfolios at low haircuts. Each basis point saved is retained every day and compounds into a material performance edge over long horizons, even when headline gross returns are similar. Winner-take-most outcomes result when economies of scale, network effects, and data advantages coincide. Firm size and wealth distributions follow heavy-tailed patterns. A small minority holds a disproportionate share of revenue, profits, and assets. Index construction reflects this. Market cap-weighted indices allocate more to larger winners as they grow. Investors who own broad indices capture the rise of dominant firms automatically. Households without market exposure do not. The same logic applies within private markets. Access to top quartile managers and direct co-investments concentrates returns among investors with scale, relationships, and governance capacity. Switching costs and lock-in protect incumbents. Enterprise software embeds workflows and data formats that are expensive to replace. Payment acceptance depends on hardware, certification, and fraud tools that merchants cannot easily duplicate. Consumer subscriptions bundle offerings to raise the perceived cost of leaving. In finance, custody arrangements, reporting interfaces, and collateral terms create inertia that favors established institutions. These frictions allow modest pricing power without immediate loss of volume, lifting returns above what a competitive market with zero switching costs would allow. Regulation and standards influence concentration. Interoperability mandates, portability of data, and open banking interfaces lower switching costs and spread network benefits across more providers. Conversely, heavy fixed compliance costs push smaller firms to consolidate or exit, raising concentration. Listing and disclosure rules can open markets to more issuers and reduce information asymmetry. Poorly designed rules can entrench incumbents by raising barriers to entry. Licensing regimes in payments, brokerage, and banking can either widen access to rails or restrict them to a narrow set of institutions. The net effect on wealth distribution depends on whether policy lowers unit costs and increases competitive access or mainly adds fixed overhead. Labor markets interact with firm concentration. Superstar firms with high margins and scalable intangibles, such as software and platforms, often have lower labor shares at the margin because additional revenue requires fewer additional workers. Profits accrue primarily to capital owners, and buybacks or special dividends distribute them back to shareholders. Employees at these firms may receive equity, but broad participation in these gains depends on how widely stock ownership is spread through retirement systems and household portfolios. Where stock ownership is narrow, rising profits at dominant firms translate into wider wealth gaps. Financial intermediation shows similar scale effects. Large banks fund at lower costs, net payments internally, and offer integrated services that capture more of the value chain. Underwriting, market making, custody, asset management, and treasury. They can warehouse risk, allocate balance sheet to clients, and stabilize funding through diversified sources, which allows them to quote tighter prices and still earn acceptable returns. Smaller intermediaries either specialize or partner, conceding fee share. Over time, fee pools concentrate in institutions that can operate at low unit cost across volatile cycles. Marketing and flow dynamics amplify concentration in asset management. Past performance attracts inflows, which lower fees through breakpoints and improve execution through internal crossing, which marginally improves after fee returns, attracting more inflows. The relationship is not guaranteed, reversion happens, but the flow performance feedback loop creates persistence for large, low-fee vehicles. Conversely, high-fee, high-turnover products face a structural handicap. Even if they select well in some periods, costs erode the compound advantage. Technology lowers entry costs but raises the bar for scale economies. Cloud computing, open source software, and APIs let small firms launch quickly, but customer acquisition, compliance, and data advantages remain scale sensitive. In markets with strong network effects, many entrants remain subscale and are eventually acquired or exit. For individuals, the same tools lower costs of investing and business formation, but the distribution of outcomes across ventures remains skewed. Broad participation in index funds, retirement plans, and low-fee savings vehicles is a practical way to share in the aggregate gains from dominant firms without needing to pick them in advance. Geography still matters through agglomeration effects. Capital, talent, and suppliers cluster in hubs where information spreads faster and specialized services exist. These clusters reduce transaction costs and time to market, reinforcing the lead of firms located there. Remote work and digital tools reduce some frictions but do not eliminate the advantages of shared infrastructure and networks. Wealth accumulates in regions that host these hubs, and property values and local services capture part of the surplus, further concentrating asset ownership advantages in those areas. Power law concentration has implications for risk management. A portfolio that excludes the few dominant winners can underperform the market for long periods. Conversely, concentration in a small number of apparent winners raises single-name risk. The practical response for most investors is broad, low-cost exposure that lets the heavy tail work in their favor while limiting idiosyncratic losses. For allocators with active mandates, risk controls on position size, liquidity, and drawdown are necessary because the same dynamics that produce outsized winners produce sharp collapses when expectations break. For households and small institutions, the way to benefit from scale and network dynamics without needing insider access is straightforward. Own diversified exposure to public markets through low-fee vehicles. Use retirement and tax advantage accounts to raise after-fee, after-tax retention. Avoid high-fee, capacity-constrained products that promise access to scale but deliver it net of large costs. When starting businesses or side projects, target niches where scale can be reached with available capital and where network effects can be localized, such as membership products, specialized marketplaces, or software with clear switching pane. Use platforms that lower your fixed costs, payment processors, storefronts, logistics, but avoid dependence on a single gatekeeper where possible by maintaining control over customer relationships and data. At the policy level, measures that widen access to saving vehicles, reduce fee drag, and ensure data portability help more households capture the returns that flow to scaled firms and networks. Competition policy focused on interoperability and switching rather than size alone can preserve efficiency gains while limiting rent extraction. Education that emphasizes costs, taxes, diversification, and the mechanics of compounding helps households convert market-wide gains into personal outcomes. Scale and networks do not guarantee profits in every case, but when they align with low unit costs, data learning, and access to cheap capital, they create durable advantages that compound. Ownership of broad claims on these enterprises allows savers to participate. Lack of ownership and high frictions exclude others. Over time, these mechanisms explain a significant share of why wealth rises faster for those already positioned in scalable assets and institutions, and why small differences in cost, access, and structure widen into large differences in outcomes. Behavior and literacy determine whether a household captures market returns or transfers them to others through timing errors, fees, and debt costs. Two investors can hold the same index fund and end with different results because one contributes steadily, reinvests, and ignores noise, while the other trades around headlines, pauses contributions in downturns, and realizes taxes unnecessarily. The gap is behavioral and compounds over time. The main errors are predictable. Overconfidence leads investors to trade too much and concentrate in a few ideas. Recency bias extrapolates the latest trend and causes buying after long rises and selling after declines. Loss aversion makes small losses feel larger than equal gains, encouraging panic exits near lows and reluctance to realize small, planned losses. The disposition effect pushes selling winners too early and holding losers too long. Availability bias overweights vivid news and underweights base rates. Present bias discounts the future heavily and reduces saving. Mental accounting separates money into buckets irrationally and ignores total portfolio risk. Each error on its own reduces return. Repeated across decades, they erode compounding. A simple process counters these errors. Define a savings rate as a percentage of income and automate contributions on payday into low-cost diversified funds. Reinvest all income by default. Write a brief investment policy that specifies target allocation, acceptable ranges, rebalancing rules, and what will trigger changes. Store it and follow it. Use a calendar or band-based rebalancing method. Calendar rebalancing restores targets on fixed dates, such as annually or semi-annually. Band rebalancing restores when an asset class drifts beyond a set threshold, such as plus or minus 5 percentage points. Both prevent drift toward unintended risk and enforce buying what fell and trimming what ran. This converts volatility into a rebalancing premium without requiring forecasts. Contribution timing should be systematic. Lump sum investing has a higher expected return when markets rise more often than fall, but many investors abandon plans after a bad start. Dollar cost averaging over a defined schedule, such as spreading a lump sum over 6 to 12 months, reduces regret and increases the chance of staying invested. For ongoing saving, contribute monthly or every paycheck. Do not pause contributions during drawdowns. Those purchases at lower prices are disproportionately valuable to long-run results. Expense control is a behavior. Select broad index funds or diversified, low-cost vehicles with expense ratios measured in basis points. Avoid frequent trading and complex products with layered fees. Decline unnecessary add-ons that raise costs without changing exposure. Compare expense ratios annually and move to cheaper share classes where available. Over a working life, shaving 1 percentage point from fees and turnover produces large differences in ending wealth without any change in market return. Tax awareness is also behavioral. Prefer low turnover funds in taxable accounts to minimize realized gains. Use tax-advantaged accounts for tax-inefficient assets like high-yield bonds and REITs, where rules permit. Harvest losses methodically within wash sale constraints, replacing sold positions with similar, not identical exposures to maintain market risk. Defer gains when possible to extend compounding on the untaxed base. Keep records of cost basis and holding periods to qualify for lower long-term rates where applicable. These routines raise after-tax returns without forecasting or leverage. Risk management must be defined in advance. Hold a cash reserve equal to several months of expenses to avoid selling assets during personal emergencies. Size equity exposure to a level you can hold through a full bear market without liquidating. If an expected 30 to 50% drawdown in equities would force a sale, the allocation is too high. Write a drawdown plan. What actions, if any, you will take at specific portfolio drawdown levels and what actions you will not take. Disable margin unless you can meet calls from external cash. Margin turns ordinary volatility into forced liquidation risk. Debt behavior often determines whether investing can proceed. Pay off high-rate consumer debt before building risk assets. The avalanche method, paying highest rate balances first, is mathematically optimal. The snowball method, paying smallest balances first, can improve adherence. Choose one and automate extra payments. Keep credit utilization low to reduce interest and improve credit terms. Favor fixed-rate borrowing for long-lived assets that produce utility or cash flow and avoid variable-rate debt that can reprice quickly. Avoid buy now, pay later and similar products that fragment obligations and increase the chance of missed payments. Savings growth comes from controlling lifestyle creep. When income rises, increase the savings rate automatically by a set fraction of the raise before spending expands. Use pay yourself first payroll deductions into retirement and investment accounts. Review subscriptions and recurring expenses annually. These habits raise the savings base on which compounding operates and reduce reliance on high expected returns to meet goals. Information diet affects behavior. Limit portfolio checking to scheduled intervals aligned with rebalancing. Turn off notifications that encourage reaction to noise. Read account statements rather than real-time price feeds. Use base rate statistics for return expectations and ranges rather than narratives. For major decisions, run a pre-mortem. Assume the decision fails and list plausible reasons. Then adjust sizing or safeguards accordingly. Checklists reduce omission errors in stressful periods. Performance chasing is costly. Fund flows show that investors buy categories after multi-year outperformance and sell after underperformance, producing investor returns below fund returns due to poor timing. Counter this by deciding allocation at the asset class level and selecting stable vehicles. Avoid switching based on trailing returns. If adding active strategies, cap their share, require documented edge, and evaluate on process and risk, adjusted metrics over full cycles, not short windows. Sequence risk requires planning for the withdrawal phase. During retirement, a bad first few years can impair sustainability. Mitigate by keeping 1 to 3 years of planned withdrawals in short duration bonds and cash. Reducing forced sales of equities after declines. Use a spending rule that adjusts withdrawals modestly up or down with portfolio performance. Rebalance from outperformers to replenish the reserve. Annuitization or partial annuitization of basic expenses can reduce longevity and sequence risk at the cost of liquidity. Evaluate based on rates and personal preferences. Human capital is an asset that can be managed. Invest in skills that raise income and employability. Diversify income through prudent side projects where feasible. Avoid concentrating financial capital in the same firm as employment. Do not overweight employer stock beyond a small limit. Insurance for health, disability, liability, and life where dependents exist protects the compounding engine from large shocks. Underinsuring against large, low-probability events is a behavioral error that reverses years of progress. Record keeping and review cadence sustain discipline. Once or twice a year, record current allocation, contributions, fees, and progress toward targets. Compare actual costs to benchmarks. Document any changes and their rationale. This practice slows impulsive decisions and creates accountability. It also surfaces silent drags like rising expense ratios or creeping allocation drift. Guardrails help adherence. Use separate accounts for long-term investing and short-term goals to prevent raids on long-term capital. Impose small frictions on withdrawals, such as a waiting period or requiring a second approval for large transfers. Align spouse or partner understanding with written plans to avoid conflicting actions under stress. For large purchases, require a cooling off period and a funding plan that does not disrupt investment contributions. Default design matters. Enroll in retirement plans that auto-increase contributions annually. Choose target date index funds if you prefer a single instrument that adjusts allocation over time. If constructing a portfolio manually, keep the number of funds small and broad to reduce maintenance and error risk. Simplicity lowers the chance of mistakes and reduces the time cost of adherence. Expectations should be realistic and expressed in ranges. Long-term real returns for mixed portfolios fluctuate across decades. Set goals that tolerate variance and emphasize controllable inputs. Savings rate, cost, taxes, and time in market. Avoid leverage to chase targets. Adjust savings or horizon if projections do not meet needs. Forecast humility prevents overreach during booms and capitulation during busts. Education closes gaps. Understanding how fees, taxes, compounding, and volatility interact changes decisions. Short, focused learning, how to read a statement, how to find expense ratios, how to set up automatic investments, how to harvest losses, has a high return on effort. Households that invest a few hours to implement these basics keep more of gross returns and avoid common traps. Institutions routinize these behaviors with written policies, committees, and systems. Individuals can approximate this with checklists, automation, and scheduled reviews. The purpose is not to predict markets. It is to capture market returns with minimal leakage and to remain invested across cycles. Over decades, behavior and literacy explain a large share of dispersion in outcomes among people with similar incomes. Those who eliminate high-cost debt, automate saving, keep costs and taxes low, diversify, rebalance, and avoid timing errors allow compounding to operate. Those who trade frequently, carry expensive debt, pause contributions, and react to noise transfer their returns to intermediaries and counterparties. The difference accumulates year after year and is sufficient to explain why many households with moderate incomes build substantial wealth, while others with higher incomes accumulate little. Crises are part of financial life. They reprice assets, test balance sheets, and redistribute ownership. The mechanics are consistent across episodes. Credit expands, leverage rises, maturity profiles shorten, and asset prices embed optimistic assumptions. A shock hits, funding tightens, collateral values fall, lenders raise haircuts, and borrowers sell assets to meet obligations. Selling pushes prices lower, which triggers more margin calls and covenant breaches. The loop continues until balance sheets are repaired or policy restores liquidity. Understanding this sequence explains who loses, who survives, and why those with liquidity and low leverage often exit crises stronger. The first distinction is between liquidity and solvency. A solvent borrower owns assets with present value above liabilities but may fail if it cannot meet near-term cash calls. A liquid position can meet obligations even when markets are closed or prices fall. Many failures and crises are liquidity failures that become solvency failures after forced sales. Preventing this outcome requires cash buffers, staggered maturities, and conservative leverage sized to adverse scenarios rather than base cases. Capital structure determines the order of losses. Secured lenders with claims on specific collateral are paid first from collateral proceeds. Unsecured senior creditors come next, then subordinated creditors. Equity absorbs residual losses and is wiped out first when assets cannot cover liabilities. Recovery rates vary by asset type and legal regime, but the waterfall is predictable. This is why long-term investors emphasize avoiding permanent impairment at the equity layer, and why lenders monitor collateral quality, covenants, and borrower liquidity closely. In corporate distress, the restructuring path often runs through standstill agreements, amendments to covenants, maturity extensions, debt for equity swaps, and fresh senior money in debtor-in-possession financing. Each step transfers control toward creditors who supply liquidity when others cannot. Margin leverage accelerates drawdowns. When portfolios are funded with borrowed money against marketable securities, a price drop reduces equity and triggers margin calls. If the borrower cannot post cash, the broker sells into a falling market. The investor realizes losses and loses the option to participate in recovery. The simple defense is to avoid margin or keep leverage low enough to survive large, fast price moves without forced sales. For institutions, stress tests should assume simultaneous shocks, equity down 30%, credit spreads wider, rates higher or lower depending on the scenario, and liquidity haircuts rising across collateral types. Maturity transformation is a recurring source of fragility. Funding long-dated or illiquid assets with short-term liabilities creates roll risk, an obligation to refinance when conditions may be worse. Banks are regulated to limit this mismatch through liquidity coverage and stable funding ratios. Non-banks that promise frequent liquidity against hard-to-sell assets face the same physics without a lender of last resort. Open-ended funds holding property, private credit, or thinly traded bonds can be forced to gate redemptions or sell at discounts in stress. Investors should align vehicle liquidity with the underlying assets and avoid relying on daily liquidity that can disappear when most needed. Policy responses change the pace and distribution of outcomes. Central banks act as lenders of last resort against good collateral to arrest liquidity spirals. They cut policy rates to lower debt service and raise asset values, purchase securities to compress term premia, and relax collateral terms to keep funding markets open. Fiscal authorities guarantee deposits, backstop key credit channels, and deliver transfers to households and firms. These actions are designed to stop solvent borrowers from failing due to temporary liquidity freezes. They also raise asset prices, which benefits owners first and contributes to wealth dispersion when ownership is concentrated. Later, when conditions normalize, withdrawal of support exposes weak balance sheets that survived only on low rates or direct support. Households can prepare for crises with simple rules. Maintain an emergency fund covering several months of expenses in cash or short-term bills. Keep high-rate consumer debt off the balance sheet. It compounds against you in any environment and eliminates flexibility. Favor fixed-rate borrowing for long-lived assets to avoid payment shocks when policy rates rise. Size equity exposure to a level you can hold through a full bear market without selling. Separate long-term investments from near-term needs so that market declines do not force liquidations to pay bills. Insure against large, low-probability risks: health, disability, liability, and basic life, so that a non-market shock does not trigger asset sales at lows. Portfolio policy should anticipate declines, automate contributions, and continue them in downturns. Purchases at lower prices are disproportionately valuable. Use a rebalancing plan that either followed the calendar or triggers when allocations drift beyond bands. This enforces buying of assets that fell and selling of those that ran, converting volatility into a small structural benefit without forecasting. Avoid concentrated positions that can fail idiosyncratically. Diversify across issuers, sectors, and regions. Hold a mix of assets with different risk and duration profiles so that not everything falls for the same reason. Keep a small, explicit liquidity sleeve to fund rebalancing and life needs without selling core holdings. Tax management is part of crisis response. Realize losses where allowed and replace exposures with similar holdings to maintain market risk. Losses can offset current or future gains and reduce tax drag on recovery. Defer realizing gains when possible to preserve deferral benefits. Document basis and holding periods to qualify for favorable long-term rates where applicable. These steps improve after-tax outcomes without requiring tactical market views. Distressed opportunities exist but require discipline. When funding is scarce, expected returns on new capital rise. Lenders can obtain stronger covenants, higher spreads, or equity kickers. Buyers of non-performing loans or restructured equity can earn equity-like returns if recoveries exceed depressed prices. However, dispersion is high and legal, operational, and timing risks dominate. Most households should participate indirectly by maintaining broad market exposure and allowing index ownership of recapitalized firms to work through the recovery. Selective forays into distressed assets without expertise can lock in losses. Organizations that survive crises typically share features. They carry more cash than seems necessary in good times. They diversify funding sources and stagger maturities. They match the duration of liabilities to the duration of assets. They limit reliance on short-term wholesale funding. They maintain covenant headroom and avoid cross defaults that transmit a problem in one entity to the whole group. They run playbooks for stress that include spending cuts, asset sales, and capital raises planned in advance. Their governance processes allow fast decisions when windows are open. The post-crisis phase is where redistribution becomes visible. Firms and households with cash buy assets at depressed prices, provide bridge financing at attractive terms, or acquire competitors. As prices recover, their equity increases faster than that of those who entered the crisis fully invested and levered. Methodical savers who kept contributing and rebalanced emerge with more units of assets than before the drawdown. Those who capitulated near lows own fewer units and miss part of the rebound. Over multiple cycles, this difference in behavior and balance sheet strength compounds into a large wealth gap. Debt overhang slows recovery unless addressed. Highly indebted borrowers reduce investment and consumption to service legacy obligations, suppressing growth. Deleveraging occurs through 4 channels: defaults and restructurings that reduce principal, inflation that erodes real debt, fiscal transfers or recapitalizations that shift debt to stronger balance sheets, and growth that raises incomes relative to debt. Each path has distributional effects. Equity holders and junior creditors bear losses in restructurings. Savers in fixed income instruments bear losses in financial repression. Taxpayers bear costs in recapitalizations. And the burden is shared when growth lifts all incomes and valuations. For individual investors, the objective is to maintain the ability to hold and to add through the cycle. This requires controlling fixed expenses, maintaining liquid reserves, and avoiding leverage that depends on continuous favorable refinancing. It requires choosing vehicles without hidden liquidity mismatches and understanding the legal protections on custody and deposits. It requires accepting that large drawdowns occur and designing a process that does not require prediction to function during them. The payoffs are delayed but material. More units accumulated at lower prices, uninterrupted compounding, and participation in recoveries that have historically followed major declines. Crises do not change the arithmetic of compounding. They interrupt it for those forced to sell and accelerate it for those able to buy. The practical takeaway is to build the right to hold in advance. Cash buffers, conservative leverage, diversified exposures, disciplined rebalancing, and clear governance keep investors solvent and liquid when markets are not. The difference between being a seller in a panic and a buyer with cash is the difference that explains much of the widening gap in wealth after each cycle. We have followed the path from the first recorded loans to modern markets where capital earns income predictably and at scale. The mechanisms repeat across centuries. Capital earns because a contract assigns cash flows to its owner, interest on loans, coupons on bonds, rents on property, dividends on shares, regulated tariffs on infrastructure, and realized gains when assets appreciate. When these cash flows are reinvested, the base grows and future cash flows increase without new hours of labor. Small differences in net return, cost, and time produce large differences in outcomes because each period builds on a larger base. The reasons wealth concentrates are cumulative rather than mysterious. People who own assets participate in compounding. People who hold only cash and wages do not. Access, rules, and behavior widen the gap. Access matters because large investors borrow cheaper, pay lower fees, see opportunities earlier, and receive primary allocations. Rules matter because tax codes, legal wrappers, depreciation schedules, and inheritance frameworks change the after-tax, after-fee return. Behavior matters because steady contributions, low turnover, diversification, and disciplined rebalancing capture market returns, while timing errors, high-cost debt, and frequent trading transfer returns to others. Policy and regimes amplify these differences. Low rates raise asset prices and reward owners first. Unexpected inflation redistributes wealth toward borrowers with fixed debt and away from holders of fixed coupons. Crises move assets from the over-levered to the liquid. The elements are observable in every balance sheet. On the asset side, there are claims on future cash flows with different risk and duration. On the liability side, there are debts with schedules, rates, and covenants. In between are rules that determine taxes, fees, and custody, and a process that determines contributions, rebalancing, and withdrawals. Households and institutions that optimize the controllable elements, cost, tax, behavior, and risk, retain more of the gross return and let compounding run for more periods. Those that do not lose return to frictions and interruptions. The practical sequence is consistent across circumstances. Eliminate expensive consumer debt. The interest you stop paying is a guaranteed after-tax improvement in your net return. Build a cash reserve to avoid forced sales during personal or market stress. Automate contributions into diversified, low-fee vehicles and set a written policy for allocation and rebalancing. Reinvest income by default. Use tax-advantaged accounts where available, place tax-inefficient assets in sheltered wrappers, and minimize turnover in taxable accounts. Keep position sizes and leverage conservative so you can hold through full cycles. Review costs annually and move to cheaper share classes or products when possible. Document changes to prevent reactive decisions. Risk control is the condition for compounding. Assume large drawdowns occur and design to survive them. Avoid liquidity mismatches between the assets you own and the liquidity you promise yourself or others. Ladder maturities on debt and diversify funding sources if you borrow. Match fixed liabilities with assets that can cover them through a range of scenarios. Ensure custody and documentation are clear so claims are enforceable when needed. Time is the decisive variable. Starting earlier creates additional compounding periods that later contributions cannot fully replace. A 1 percentage point improvement in net return sustained over decades creates a meaningful gap in ending wealth. Lowering total costs, deferring taxes legally, and avoiding big errors often achieves that improvement without taking more market risk. Discipline applied consistently is more valuable than occasional outperformance, offset by higher volatility, fees, or taxes. Policy can broaden participation in compounding, default enrollment in retirement plans, low-cost public options, data portability, and transparent fee disclosure help more households keep more of gross returns. Consumer credit safeguards reduce negative compounding from high-rate debt. Clear insolvency frameworks and credible monetary policy lower risk premia and improve access to investable projects. These measures do not remove risk or equalize outcomes, but they reduce avoidable frictions that separate similar savers. The historical record shows that money working by itself is a shorthand for contracts, institutions, and behaviors that channel cash flows to owners of capital and allow those cash flows to be reinvested. Merchants at fairs, bankers with ledgers, states with funded debt, and modern investors with index funds all rely on the same arithmetic. Where ownership is broad, compounding benefits many. Where ownership is narrow, it concentrates. At the household level, the levers are clear. Earn more than you spend, remove high-rate liabilities, buy broad claims on cash flows at low cost, reinvest income, manage risk to avoid forced selling, and let time pass. The decision set for an individual is finite and executable. Today, set an automatic monthly contribution into a low-fee diversified vehicle. Map a target allocation and rebalancing rule and write them down. Identify and retire the highest rate debt. Establish a reserve covering essential expenses. Review account types and move tax-inefficient assets where rules allow. Turn off non-essential notifications and set a quarterly or semi-annual review cadence. These steps raise the net compounding rate without requiring forecasts or uncommon access. Wealth grows where net return exceeds friction and where the owner can hold through full cycles. History explained the mechanisms, process turns them into outcomes. The gap between capital that compounds and capital that does not is the core reason some households and institutions see wealth rise faster across decades. Closing that gap is not a matter of a single decision, but of a system built to collect cash flows, reinvest them, and avoid large, avoidable losses. The earlier that system is in place, the more it does on your behalf, quietly and continuously, year after year.